Good morning and welcome to this Wednesday, May 5th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, first, happy Cinco de Mayo to everyone. Unbelievable that we're already into the fifth month of the year. It seems like we just started 2021, and now we're well into the second quarter, really getting into the heart of earnings season. Just a ton of companies reporting. Most of the big companies have already reported. You know, when you think about the Dow and many of the S&P 500 companies and so forth, but all the other companies now are reporting. Companies that maybe don't have the same size accounting departments, takes a little bit more time to get their earnings information together. But we literally have hundreds of companies reporting each and every day. And that's going to make things pretty exciting here, really for the next 10 days to a couple of weeks or so. As far as the market today, we are at least seeing a little bit of a bounce back in technology, which is good. That's a group that, when you look at the S&P 500, it's been pretty strong, and it's been strong, especially recently, with not a lot of support from technology and consumer discretionary, which account for quite a bit of the S&P 500, probably 35% or so. So the S&P 500, you have to realize, has been very strong when you consider the technology and consumer discretionary have been holding it back, and yet it's still been up trying to push to new highs. That tells you just how strong some of the other areas within the S&P 500 have been. But currently, futures, last time I looked anyway, Dow futures were up about 80 points, S&P 500 16, NASDAQ 87. Now, that's still a little bit off of what we saw yesterday. The NASDAQ lost 261 points, so it looks like it might be primed to get back about 1/3 of those points. So it's got a lot of work to do. The good news is I think it's just rotation. I think the themes clearly have changed from now to when you go back the last 3-6 months ago. But I think that it's been good for the market in general. I think the S&P 500 continues to suggest it wants to go higher. Now, there have been some warning signs out. I've written about those recently. We've seen especially the NASDAQ struggle more so than say the Dow or the S&P 500. But I wouldn't be surprised as we move into the second half of May. That's when we tend to start to see more weakness. So if we do get another push to the upside, there are some things I'm going to be watching. Obviously, some of the divergences. I'll also be watching the volatility index. If we keep moving up, but it's trying to climb that wall of fear. If the fear is building with the market moving up, I think that would be a really big warning sign that we'd have to pay attention to. But again, any kind of setback in the market, I believe, will be short term. So I'm not talking about long term issues, but could the S&P 500 fall 5%? Yeah, I think it could. Don't know if it will. If technology continues to perform the way it is, then I think there's a very good chance the S&P 500 could pull back 5%. But I'm going to look at the technology area in just a bit. And I think, maybe things, again, it's all about perspective when you're looking at the stock market. I know technology, number of the technology companies, many of the recent leaders that I'm talking about throughout the pandemic have struggled, and many of them have struggled a lot. But when you look at how much they outperformed and trying to time, that move to the downside is always very difficult. I mean, we could have done it in June of last year, in June of 2020. Remember, that's when airlines took off and many of the tech stocks got hit. But then the tech stocks came back and tech stocks led again. Then we got into that September period. Same thing. Money rotated away from technology for a period of time and then started to come back again. But there's definitely been this rotation in this past quarter. And a lot of it was triggered by that IWF, IWD ratio that we like to look at from time to time. And I'm going to pull that up for you, and we can take a look at that in just a few minutes. But we're going to go through and check out the action from Tuesday here in just a second. I do want to Just make those of you that maybe are new to Earnings Beats aware, we do have a free Earnings Beats Digest newsletter. We just published one this morning. It gets published 3 times a week, Mondays, Wednesdays, and Fridays. Comes out before the market opens. Simply type in your name, email address, hit the subscribe button. We'll get that sent out to you. We normally focus on earnings, relative strength, those types of things. And we'll show you a little bit of how we approach the market on a daily basis. And I think you'll be able to apply some of those things to your own trading to hopefully help you in the future. So again, go to earningsbeats.com, sign up with the name, email address, hit that subscribe button. No credit card required. It's free. You can unsubscribe at any time. All right, let's take a look at what happened on Tuesday because it wasn't a very pretty day. The good news, you can see the Dow Jones, which has gone down and tested the 20-day moving average, came back and actually rallied and finished up for the day, up 20 points, back above that 34,000 level, even though it had been struggling. AD line, very strong. So Dow Jones stocks look really good at this point. Can't really argue overall with what's going on with that index of conglomerates. S&P 500 down 28, but it did rally off its earlier low. It was down below the 20-day moving average. It was challenging the lows, got close to the lows that we saw back in mid-April, and then we bounced off of it. So again, we had buyers stepping in, not a bad thing at all. There is a slight negative divergence on the S&P as it moved up, set a new high. You can see that that PPO is lower. So, when I talk about the possibility maybe of a 5% move to the downside, that would essentially take us back to the 50-day moving average. And we've done that plenty of times in the past. So I wouldn't rule out that possibility, but we'll continue to monitor the short-term warning signs, and I'll be reporting those to our members in the daily market report. And I'm sure writing about some of that over in my blogs at Stock Charts from time to time. I wrote an article on Saturday, by the way, talking about many of those warning signs. So if you haven't checked that out, please do. The NASDAQ yesterday was the one that really got hit. And many of the leaders, you can see how quickly things have deteriorated here. I mean, we were down 750 points from the high last Wednesday morning to the low on Tuesday. Or actually, this was Thursday morning. Thursday morning through Tuesday. I mean, we're talking about 3 trading days from the start of the trading day on Thursday through basically the early part of trading on Tuesday. the NASDAQ dropped 750 points. Talk about a 5% correction. That was 3 days. That's how quickly things rotated in the NASDAQ. And that came on the heels of some really strong earnings reports. I don't believe this is a company specific thing. I think this is a theme thing that's going on in the market right now. It really doesn't matter. I mean, there are a few exceptions, but for the most part, companies that were leading during the pandemic are being tossed aside, and everyone's saying, okay, let's just rush into the stocks that were not performing well last year and let's build them up. I think that's good for the market overall. I think that makes the market healthy, but I believe that rotation will rotate back at some point. I do think as we get further and further into 2021, we're going to have a more normal market, though, which probably everybody will like, or at least you should. Mid caps and small caps both were down, but they weren't down anything like the NASDAQ, and they did both outperform the S&P 500. Also holding on to their key moving averages, and across the board, even the NASDAQ with all the selling, that AD line still, to me, looks pretty good. We've pulled back a little bit, but like I said, we pulled back 5% in the index over 3 days. So that's to be expected, the AD line dropping. Looking at the individual sectors, materials, financials, industrials led yesterday. Big move up on the material stocks, gaining more than 1%. Financials and industrials, but also did well. And we really haven't seen a huge pop in the 10-year Treasury yield. So I think the market is simply anticipating that the yield's going to go higher. And as a result, they want to be in financials and industrials. So that's what continues to lead. As I mentioned, technology, consumer discretionary, this is the area of the market that was hit the hardest. Both of these groups did bounce off of their lows of the day, but you can see technology down almost 2%, discretionary down more than 1%. AD lines across the board, I still think pretty strong. You might argue, well, technology is rolling over, but that was a pretty big drop. Yesterday, that doesn't really impact the AD line much. When you gap down, trade down intraday, and you come back up and close in the middle of a candlestick, the way that the AD line is calculated, it looks at it as a close in the middle of the candlestick as neutral. So you can see right here that AD line went sideways. It didn't go down yesterday, even though technology was down 1.79%, because it's not looking at where we closed the day before. It's only looking at what happened during the day. It looks at the high, it looks at the low, and where you close. If you close in the middle, it doesn't have much of an impact on that AD line. Anyhow, let's keep moving. 10-year Treasury yield. First of all, we did have the ADP employment report come out this morning, and I thought the jobs number was pretty good. It was a little less than expected. The April ADP employment report showed 742,000 jobs. The market was looking for 785,000, so a slight shortfall. But at the same time, we had March revised higher from 517,000 to 565,000. So if you look at the net, we actually had more jobs when you consider revisions for March. The jobs were actually higher this month than they were in the prior month. All right, later this morning, we've got the April PMI composite coming out. The expectation is for a rise from the March level. March was 59.7. We're expecting 62.2 for April. And then the April ISM services number, also expecting to rise, a little bit more of a modest rise, from 63.7 in March to 64.2 in April. Looking at the 10-year Treasury yield, let's make sure we got the latest here. We're basically flat, up maybe close to 1 percentage point or 1 basis point, 1.60%. But as I mentioned, you can see the last couple of days we've been moving lower in the 10-year Treasury yield. I think just consolidating. You know, at this point, I don't really look too much at whether it's going up or it's going down. I look at the key resistance and what I consider to be key support, which I would say is still down at around 150. Resistance up at about 175. Anything that takes place in between those two levels to me is just noise. To me, the big story is going to be, do we break out above 175? Do we break down below 150? My guess, if I had to put my money on it, would be that we break out above 175. I think rates go higher, and I think that's what the market is expecting. And if you've noticed recently, we're getting a lot of talk, and I think this is one thing that's contributing to a lot of the selling in technology and other growth areas. But over the weekend, Warren Buffett was talking about inflation, saying that they're seeing it in their business and they're raising prices. That doesn't help. Anytime you have an inflation, the inflation talk, that's going to send interest rates up, and that's going to be a negative for growth stocks. Also, you know, inflation eats away at that future earnings growth potential. So it's really a double whammy for technology or any growth areas of the market when any kind of talk about inflation begins to surface. And that was one thing we talked about over the past couple of months, is we're going to see some inflation talk here over the next couple of months. And that may really continue to impact these technology names and some of the other growth names in other areas of the market. So it's something to at least keep in the back of your mind, something we've talked about. Oh, and then also Treasury Secretary Janet Yellen talked about interest rates, you know, that potentially we're going to need some interest rate hikes so that the economy doesn't overheat. So it doesn't always matter just what the Fed is saying. We've got so many stories circulating and so many assumptions being made. And unfortunately, a lot of times market participants start to look at these news items as fact, and they're not fact, they're speculation. So, but it does still impact the market in the near term. I believe when all this is said and done, there's going to be a tremendous opportunity in many of these growth names, but trying to say, you know, predict when the bottom is going to be in, very hard to say. But one thing I do want to point out is, I'm going to bring this chart up over here. This is that IWF-IWD chart. And let me just change this from a candlestick chart. All right, so this is a 1 year. I'm going to go back further. Let's do 2 years. So you can really get a sense of what's been going on here. So throughout really the beginning of 2020, even before the pandemic started to set in late February and throughout March, April, and so forth, we were already starting to see money rotating into growth. And part of that was because yields had been dropping. So maybe I can put that on this chart as well. We can kind of see what was going on with the yields. All right. So if we bring this up, TNX. So here you've got growth and here you've got the yield down here. So you got growth versus value and yield. Notice that we started dropping here in late December, early January of 2020. Big drop in yields. And that's what started to trigger that move in growth stocks because future earnings become much more valuable. And growth stocks are increasing their future earnings much more rapidly than value stocks will. Value stocks are going to have much more stable earnings, and growth stocks are going to have much more, rapid acceleration of their growth in theory. So when you get rates dropping like this and the economy, pretty strong, which at the time it was, if you recall, we had a pretty strong economy before the pandemic set in. That's what started to trigger this. Now, when we had the huge drop in March and April, we had the initial hit to a lot of key areas. And in fact, throughout March, we saw just about everything going down. But on a relative basis, the growth stocks took off. And I think that was for a number of different reasons. But the primary one that I was looking at when I was looking at AD lines is that institutions were accumulating half the market while everybody was panicking out. Half the market was being accumulated, the other half was being trashed. And so for the balance of the year, the part of the area or the part of the market that was being accumulated outperformed in a major way. I mean, this was going from a ratio of 1.3 to 1.9. That's a lot. That's a lot of outperformance in a very short period of time. And when we hit the warning signs in early September, that is essentially when growth topped relative to value. Now, there were still a lot of growth stocks that did well, but on a relative basis, that's where we topped and started to roll back over again. Now, if you look at this, I'm going to draw a couple of lines that I would keep an eye on. So right here is a key. This was a top in May. We pulled back in June. Remember, I talked about a lot of the money rotated into areas that had been struggling in June, and many of the technology names went down in June. Well, this was the big drop. And yet technology came roaring back. In fact, went back through this relative ratio, this relative resistance of 1.70, 1.69, 1.70. Notice as anytime we pulled back over the next several months, we held that 1.69, 1.70 level until the latter part of February. And it's really been this period here over the last couple of months, 2.5 months, where growth stocks have been tortured. And I don't even know that this does all the justice to how bad some of these names have been beaten up. But here's the key, and I always say this: you've got to look at the charts with perspective in mind. The ratio was at 1.30 to start 2020. We went to 1.90. We're sitting at 1.60. We're still growth stocks throughout this period still have outperformed significantly value stocks, but we're in a period of transition and rotation right now. I don't know how long this lasts. I do not believe this is a long-term downtrend. I just don't. I think rates will still stay historically low. Yes, they might go to 2.5%, 3%. I think that's possible. That's still very, very low interest rates. And so while everybody is torching technology and consumer discretionary and throwing them out, I think they're going to become extremely cheap on a relative basis. Now, again, is that today? Is it next week? Is it next month? Is it going to be in the fourth quarter when things, really start to turn back up for growth stocks? That's a difficult part. What I can say, though, is that as this ratio declines, I think the market is actually a lot healthier than it was back in the middle of the summer last year, because more and more companies now are participating. And you might say, well, technology is not participating. Well, technology actually is still participating. It's just a lot of the leaders aren't. I mean, there are companies that have had tremendous earnings reports this quarter, and they're being trashed. Last week or so, the moves lower in stocks like Apple and Shopify and some of these companies are just crazy. And so let me pull this. And by the way, the other thing, you can see that we topped on this ratio at about the same time we bottomed in interest rates. So as interest rates have been rising, That does, I mean, that's one half of the equation of valuing technology companies, growth companies. Higher rates are a negative. However, growth is not slowing down. Growth, if you look at most of these earnings reports of these companies, growth is accelerating in these companies. So we're going to get to a point where growth is moving too far. Everything in the market goes too far. The outperformance, it's easier hindsight, of course, 2020. But we went too far to the upside. I think we're going to go too far to the downside. Whether or not we're already there, I don't know. This 155 level, I'd keep a very close eye on because you had a major bottom there in that June high for many of the airline stocks. The companies that got hit in the pandemic, they came roaring back into early June, and that sent the growth versus value ratio down to 155. When we fell apart back in February, right here below that 170 level, where did we go? 155. And then we bounced off of that, couldn't get back through 170. And now you can see we're rolling back over again. If we go through 155, and there's also a low down here in early April around 150. So maybe you give it both these levels. I don't think we're going to go below that. I mean, I cannot fathom that we would go back to 130, which is where we started this whole thing from, not given the environment. I just don't think it's going to happen. It doesn't make sense to me. But I would follow this ratio. I think when we ultimately break back up above 170, I think that's when you're going to see many of these technology stocks, consumer discretionary names doing extremely well again. In the meantime, let's just be aware that we're in a downtrend here. And so expectations, that bar should definitely be lowered on these companies until we start to see the money rotate back into growth versus value. And that is not the case right now, as you can see. So let's take a look at the technology chart. Now, if you just looked at this and didn't know what was going on in the market, you would say, hey, this isn't a bad looking chart. I mean, we just keep going higher and higher. Yeah, we've had pullbacks, but we keep putting in higher lows. Nothing wrong with this chart. What's wrong with it is really the last week where technology has completely fallen apart here, dropped $10, $9 or $10 on the XLK, while the S&P 500 has been relatively unscathed. I mean, we look at the S&P 500, we came down a little bit yesterday, but we're, one solid day away from another all-time high. And so that's the part that I think is frustrating, is that many of these technology names are not participating right now. They participated in a wild way on the way up, did extremely well. Now we're seeing the flip side of it. Let's pull up the XLY. Consumer discretionary also struggling the last couple of days, but at Monday's high, we were near an all-time high on the XLY. So we've still got plenty of areas in consumer discretionary that are doing well. There are plenty of areas that were doing well that aren't, but they're all kind of offsetting one another. So XLY continues to be strong. The one thing you have to understand about a secular bull market as opposed to a secular bear market, when you're in a secular bear market and growth stocks get hammered, which they normally do in a secular bear market, money doesn't rotate to other areas. Money leaves the stock market. When you sell technology, you just get out. You don't look for other areas of the stock market. In a secular bull market, the opposite is true. When one area fades, other areas pick up the pace and just continue. It's almost like a 400-meter relay. You just pass the baton on to someone else who runs for the next 100 meters. And after they're done, they pass the baton, somebody else takes off. This is what's happening in the stock market. It's this rotation that continues to drive the stock market to the upside. Big picture, that's very bullish. And it's why I continue to talk about this secular bull market theme. So the question is just what's leading, what's not leading. And to be quite honest, I mean, I would continue to look at our relative strength, whether it's our sectors. You can see right here, here's technology rolling over. Technology right now is at the lowest level it's been since back in July of last year, relative to the S&P 500. Now, it hasn't lost a ton of ground, but it's not uptrending like it was. And so that's obviously a problem. The XLY, we had the huge downdraft in February. We tried to bounce back up, starting to roll back over again. So consumer discretionary, not particularly strong on a relative basis. Communication services had that relative high in March. Since then, it's kind of been moving back. But then when we look at financials and industrials, here's industrials moving to a new high. You go to financials, moving to a new high. This is where your leadership is. Now we can go into some areas. Now, other areas, some of the defensive groups have been performing better. I mean, you can see real estate has been climbing, but do you see the difference? Still, to me, in a long-term downtrend, which is where you normally will stay when you're looking at defensive groups in a secular bull market. They don't tend to lead. So yeah, they were beaten up really badly going into the beginning of the year. We've seen a relative rebound. I don't know that that's going to continue. Whereas I do think financials and industrials have the staying power to continue to lead. And then you look at energy and materials. Now, energy clearly has been a huge winner in 2021, really since the November low, once the positive vaccine news came out. This is a group that has performed well. It had pulled back in March, early April. It's starting to turn up again. I'm okay with energy and I'm okay with materials as long as we continue to monitor the dollar and just be careful, because when that dollar surges, which I think it could later this year, these are groups that could be hurt the most by it, energy and materials. But materials have broken out again. So if you're looking for trades, short-term trades in the market, I would continue to be looking at materials, energy, financials, and industrials. Those are probably, and you've got areas, pockets, especially within consumer discretionary. I still like the hotels area. I like travel and tourism. Some of those areas within consumer discretionary, I think, continue to perform well. All right, let's move on to earnings. So earnings out last night and this morning. Start off with T-Mobile. They just crushed their earnings, 92 cents versus 55 cents. I mean, this is the kind of thing that we've been seeing. I'm going to go back over here for a second and let's pull up T-Mobile, see what it's doing in the pre-market. So T-Mobile is up 2.75%, back up to 132. Still hasn't broken out, but that was a great report. And again, that's kind of what we're seeing across the board. Most companies are beating. Activision Blizzard beats 84 cents versus 69. Now, this is a stock that had been beaten up pretty badly of late. It's bouncing 5% with a good report. So maybe some of these stocks that are testing key support will bounce nicely off of it. Prudential, talk about a big beat. $4.11 versus $2.68. These aren't small beats. These are massive beats. And so Prudential, which has been in a nice uptrend, getting another pop this morning, another couple percent. Let's talk about a stock that missed last night, Verisk Analytics. So $1.23 versus $1.25. I would argue that, off of the 210 high going down to 160, some of that was built in. We had moved back up. Now we're down $4.62, back below that 20-day. I'd be careful with a stock like this because it was obviously lagging to begin with, and then it misses. And so probably not going to be a very good period ahead for Verisk. At least I wouldn't expect it. Next up, how about Ring Central? 27 cents versus 25. Stock's been beaten up badly, though, heading into this. So it is getting a little relief up to 305. It's got a lot of work. I mean, I don't think you're out of the woods here on the stock to get through 340. So, yeah, we're bouncing back up. But remember, yesterday, we were up probably 310, 312. So today's gain back to 305, it erases a lot of yesterday's selling. But I certainly wouldn't say that we're in any kind of a bullish move here. I think it's way, way, way too early to say that. Let's take a look. How about, one of our stocks missed estimates, one of our portfolio stocks, Upwork. And Upwork down 5% today. Upwork came in with a loss of 6 cents. The market was expecting a loss of 4 cents. That one was surprising to me. And it's actually, the reaction so far is not as bad as some of the stocks have been beating. So trying to make sense of all of this doesn't really make a whole lot of sense. But it is in a downtrend. I would watch this $40 level pretty closely because $40 has been holding a support. We haven't had any closes below 40 since back in January. So this is an area where I would hope with the move to the downside that we'll see buyers come in, maybe a hollow candle print, but we'll have to watch to see. Many of these growth stocks, though, I honestly, I don't like to see them miss earnings estimates because their value in many instances is based on earnings growth. So if you're missing your earnings estimates, chances are your future estimates are going to come down unless analysts believe that it's just a one-off quarter where you had some issues that you won't have going forward. If those estimates start coming down, your valuation is bound to come down. So that's something to keep in mind there. Let's look at one more came out this morning. Actually, two more. One is, and I think the market just opened. So let's pull up the chart. First is GM. GM had a big quarter, $2.25 versus $1.02. And the stock opened up 3%, but still kind of mired in this sideways consolidation. So not really seeing any kind of major reaction there. The last one I'll pull up is Train Technologies, TT. Really good report here, $1.01 earnings versus 62-cent expected. So Train Technologies in this nice uptrend, up, well, close to 0.7%. Anyhow, let's get a quick update on the market and let's wrap this thing up. Actually, we didn't do the three you must see. One stock that I think maybe has really struggled, but I think probably be worth keeping an eye on is Vertex Pharmaceutical. This is a company that really likes the seasonality in May and June. So you can see the stock right now pretty flat today. It's been in this downtrend, but if you're a believer in seasonality, let me give you the seasonality chart. We'll make this the second chart. VRTX. And if you go back the last 20 years, you'll see that May and June have averaged, Vertex has averaged going up 12.5% during these 2 months, May and June. So I know the chart doesn't look good, and usually I like to see some kind of corroboration of solid technicals. But maybe one thing to consider here with Vertex is if it does weaken in the near term, and let's say we go down and we test 205, that would be an area that I'd consider the stock simply because you're at support and you've got these strong seasonal tailwinds. If you break down, you can get out without losing much. And then if it starts to strengthen later, you can always get back in. So I would consider the stock if it got down closer to 205. If you're someone who likes to buy stocks on pullbacks, you like to get support, that type of thing, there's lots of different ways to trade. You can trade momentum, but you can also trade key support levels. And this is obviously a pretty big one for Vertex as it gets closer to 205. All right, one other stock. Let's see. There was another company that reported. Oh, let's look at Lyft, because Lyft reported yesterday after the bell, they reported 36-cent loss, but the market was expecting a 54-cent loss. So let's see what's going on here with Lyft. Gapped up initially, but starting to roll back over. I would simply say this on Lyft. I think where it broke out last time, that's where your key support comes in. So I think if you get, you've already held up here at 55 with a tail below it. If you like Lyft, I would consider two entries, 55 and 50. You get a close below 50, I'd get out. That's the way I would be looking at the stock. Did beat on its earnings. I haven't seen revenues, but if it beat on revenues, it will be on our strong earnings chart list simply because it's in this nice uptrend. All right, quick update on the market here. We've got Dow up 47 points, S&P up 17, pretty nice move there. NASDAQ getting back 110 points, that's nice, up about 0.8%. Small caps, mid caps, both higher, and the volatility index is down today. So we are seeing that inverse relationship, which is what we normally see. If we're going up and you see that VIX start to pick back up again, goes through 20, that's where I would be much more concerned about the short term. All right, everybody have a great day. Wishing you happy Cinco de Mayo. Take care, happy trading, and see you tomorrow over at Stock Charts TV. Happy trading, everybody.